So I've been an avid fantasy baseball player for a long time, and I've always found it to have some parallels to the investment universe. And I started in fantasy baseball with a regular draft, but more recently I've really just done an auction draft. And what happens is you have an open outcry and people get to bid, and the market sets the price for what a player's worth. And each and every year there are a batch of young players that come into the season with a whole lot of hype, and people pay exorbitant prices for these players. And, you know, it's much like in the market. When you have a young company that shows a lot of promise, people want to be a part of it, and they're willing to be pretty indiscriminate towards price, and they just want to be in. And that's kind of what happens with a lot of these young players. And then what happens is there's a base case for how a player will develop in the major leagues. And it typically takes time. Even some of the best players, they don't really hit their stride until they're 26, 27, but people are bidding a whole lot for them as these 18, 19, 21-year-olds. And when the player performs in line with what would be the normal trajectory of a very good Major League Baseball player, but below what a lightning-in-the-bottle superstar would look like, the next year when the draft comes around, these players tend to be completely off the radar. It's not just that people pay a lower price for them, it's that they almost forget that they're there. And a good example of this, a player who recently, I think, has gone through some of these fits and starts, is someone like Justin Upton, who several years ago he comes onto the scene, and he's the younger brother of B.J. Upton, so everyone knows the name. He's a phenom, and he's crushing home runs, some of the farthest home runs you see in Arizona. And then, you know, last year, so it's not necessarily his second year in the league, but last year he really had an off year. And people kind of, this year, he moved to a new team, and people really didn't come in with as high expectations for him. And in my auction, I was able to get him basically for what I'd call the average Major League Baseball player price, even though he was well above average and he had the potential to do quite a bit more than what the average could do. And it turns out that this year, I mean, he's off to a great start. It's early yet. I'm not going to prejudge. But it's the type of situation where you really want to find something that has a lot of hype with merit. And there's a reason why people are indiscriminate in approaching what could be. But then they forget about it because people have short-term memories with these types of things. And in investments, I really like to look for situations where I could find a stock that I want to know what's going on when there's hype. I want to follow it when the hype is there and really understand why people think this way about it. Ideally, it's a company that's been around for a while that I really have a good idea of who the management is, what their incentives are, why they're doing what they're doing, and why they're achieving the success, and why people are looking at them in a positive light. But also at the same time, I want to be well aware that these types of things tend to have a really long duration, and they tend to be very sensitive to very, very small changes. And when these small changes happen, and they happen for the worse, and the momentum unwinds, that's really when I want to take my deeper look, and I really want to focus on what I could get from an investment perspective. And when I look at it, there are two things that I'm looking for. I'll take a step back. Early on, I was working on a trading desk, and one of the brightest guys in the room said to me that when he's looking at an investment, investment's even the wrong word. When he's looking at a situation, he's looking for some situation where he could quantify his odds and the probability that he'll be paid out on those odds. And he's going to incorporate these two ideas, the relationship between the odds and the probability, in order to put a dollar value on the trade he's going to make. And this guy was able to make tremendous amounts of money in the markets without ever doing any fundamental research. It was purely based on having his very, very narrow idea of how he could define the relationship between the odds and probability in any given opportunity. And it just so turns out that in investing, there's a formula using the relationship between odds and probability called the Kelly criterion for capital growth. And this came out of Claude Shannon is credited as one of the first to introduce it to Ed Thorpe, who, if those of you know, is the guy behind the group of MIT students in the movie 21 or the book Breaking Down the House. And one of the things that's most interesting relating it to blackjack is that in 21 and Breaking Down the House, the focus is entirely on the process these young kids used to count cards. Meanwhile, the real power of their strategy had nothing to do, well, it had something to do with how they counted cards, but the card counting process was really only about defining the odds and the probabilities in the situation, and the magic of the 21 or Bringing Down the House approach was this formula for capital growth. And that's just a good behavioral example about how people really don't necessarily look at why a situation worked in the right way. There's a much better story to be told about counting cards than about nerds using numbers to quantify their pot odds in a given situation. So to take that back to the post-hype sleeper, when you get in these situations where the momentum flushes out and you can really just focus on the fundamentals, you tend to have also a pretty wide... there's no one base case for what's likely to happen. There are a whole number of possible situations that could result. So one of the problems, going back to the Kelly formula, is that you can't necessarily define it in binary terms where there's winning or losing. There are shades of winning and there are shades of losing. But you could use all this information to come up with a probabilistic estimate for what's most likely to happen and what the values accompanying those likelihoods are to be. And you could find very real disconnects between the price of a wager in terms of the probabilistic price and the market price. And so this gets to, in value investing, a lot of people talk about how a bird in the hand is worth two in the bush. And that's mostly true, but it's not always true. If I told you you could every single day have the choice of a bird in the hand or two in the bush, and you had a 60% chance of the two in the bush every day, and this repeats in perpetuity, you'd want to take the wager every single day, because in aggregate you'd end up with more than one bird per day. And it's something that behaviorally is very important. People have an aversion to losses. People are scared to take risk. And when we could define the risk and we could get really comfortable with how it's defined and we could get comfortable with our odds, then we could really take on the two in the bush in a very constructive way.